Thank you for joining us for today's live webcast, Third-Party Management Fundamentals. Before we launch into what I'm sure will be a very informative webinar, I want to bring your attention to our first slide. You see right here we have some resources which will be accessible to you on our website at www.hiperos.com. At the conclusion of this webinar, we will distribute these slides, which will include the embedded hyperlinks, and they will bring you directly to the resources that are on our website. I'd like to introduce today's speakers. It's my privilege to introduce Linda Tuck-Chapman. Linda is a widely recognized expert in third-party risk management, outsourcing, governance, and sourcing optimization. Her unique insight and expertise is built on her experience as Chief Procurement Officer in 3 of North America's largest banks. I'd also like to welcome Mark DeLuca of Hiperos. Mark is joining us today as the moderator of today's webinar and also as the subject matter expert. Mark has been in the third-party management space for 7 years and is responsible for the commercial organization here at Hiperos. And with that, I'd like to turn this webinar over to Mark to give us a quick overview of Hiperos and then set the stage for today's webinar.
Thanks, Sharon. And thanks, everyone, for giving us the opportunity to spend a little time with you and to tell our story. So the good news is we won't be giving you a big sales pitch on Hiperos today. That's not the purpose of today's webcast, but a little context may be helpful. So Hiperos was founded in 2007 specifically to serve what we saw as an unmet need in the marketplace, third-party management, or what we call 3PM for short. And just about that time as we exited the startup phase as a company, the financial crisis hit, regulatory pressure kicked in, and we were very fortunate to be in a place and time when a lot of banks adopted our solution. TD Bank, BMO, BB&T, Schwab, State Street, many others, including 3 of the 4 largest credit card companies in the world. And that really shaped our offering as a young company and set us up to become a great provider for all of those third-party oversight organizations like yours. So shortly after that, governments around the world really just woke up one day and started enforcing the ABAC statutes. The DOJ with the U.S. FCPA statute, which had been on the books since the late 70s, and then other governments kind of jumped on that bandwagon. And what companies found is that our 3PM or third-party management model that works so well for banks had really become a silver bullet to many of these non-bank institutions like, you see their logos up here, Alcoa, Halliburton, Merck, Microsoft, et cetera, which is great because it gives Hiperos this very wide base of clients upon which to build a very strong best-in-class offering. So today, fast forward a few years, as our clients' third-party management organizations mature, many are in a place where the fires have been put out. They can now kind of breathe a sigh of relief, step back, and revisit their approach to third-party management. Now with all the plumbing in place, clients can figure out how do we improve the defensibility of our program? How do we go wider in terms of process coverage to address the new OCC guidance? How do we go deeper to address things like subcontractors? So on that front, the industry is really now embracing guidance from experts like Linda Tuck-Chapman. Linda ran the third-party oversight program at a large money center bank, so she really has practitioner experience as well as industry experience. So with that introduction, I'll pass the floor over to her so that she can share her insights.
Thanks, Mark. So this is Linda. What we're going to talk about today are things that are on people's minds. So we've entitled this Fundamentals, and the reason why we're doing that is we're really kind of going back to basics. Third-party risk management has been in place for a few years now, and what's happening is really the acceleration of the programs, the maturity of the programs, and in doing so, as we all learn along the way, I think a lot of companies are revisiting the programs they put in place, and now they're looking to strengthen them and enhance them. So it's back to what Mark was just talking about, sort of that deeper, broader program that will cover your organization. And so this is really not a regulatory exercise. I know in talking with executives across the financial services sector, there really is an appreciation for improving overall business outcomes, improving risk management. And so in doing so, it allows companies really to expand, to consider basically what's most important. And in my own personal experience, it provides insight to senior executives that they've just never had about their relationships that help them run their business. I have included this quote from Thomas Curry, who is the controller of the currency with the OCC. And I really do appreciate, you might want to read his speech to the American Bankers Association last year in 2014. And what I wanted to pull out of this is that basically not just banks but executives and C-suite across these organizations, this function is now getting the attention that it deserves. And unlike in the past where you may have not been able to attract the best people into what was considered a compliance function, it may not have been a career path that a lot of people were thinking about, and that's probably what I really meant as opposed to the best people, but really looking at it as an optimal career path. It really is a recognition that the people there performing risk and management and compliance functions are as important to the organization as any other key function. And so that's being acknowledged not just by Thomas Curry, but executives everywhere. So moving on to the next slide, I wanted to give you a background of the context for action. So I have the privilege of being the subject matter expert for the Risk Management Association. A lot of financial services companies in North America belong to the RMA. And so we did a survey last year in 2014 trying to get our first baseline on what's happening in third-party risk management. So not a single company of the 102 banks that responded said that they found their program to be completely mature. And I think in fairness, there would be probably the same today because this is a quick evolution. The size of the programs basically, there's kind of rule of thumb, but basically some are small, some are big. And I think a lot of it is trying to define what criticality means, what should be in the program. And we'll talk about that a little bit later. And so as Mark mentioned, the OCC has now determined that any company that you do business, any person, any company that's not a customer belongs in the third-party risk assessment program. And that's kind of an interesting thing because when you look at the numbers, I think we haven't seen very much of what's actually going to happen. Some of the companies that are in the lead here are finding that the number of non-vendor third parties exceeds the number of vendor third parties, which is interesting. And so actually the RMA has we have a survey coming out shortly on that. And one of the things I do note is last year there were very, very few people in these organizations, and that, I think, is beginning to change. So I'm going to turn it over and ask you a question, Mark. What are you seeing in terms of the number of, specifically vendors? I think most banks have vendors today in their program, and some have other third parties. What are you seeing in terms of volumes and numbers of relationships that are in these programs?
So it's changed considerably since we started out, Linda. I can remember one of our earlier banking clients focused on 268 third parties that they had in a Lotus Notes database, and that was the target of their initiative with Hiperos. Today, for new banks that are coming to Hiperos, generally what we see is a tiered approach where at the top of the funnel, I need to capture all third parties and do a materiality assessment on those third parties to figure out which are material and which aren't, so which are in scope for our program, and then go from there. And the reason they want to do that is so that when the OCC examiner walks in the door, or the CFPB examiner, or the DOJ, I need to be able to look that examiner in the eye and say, if I'm doing business with them, they're in there. They've been risk assessed, and they're on a compliance protocol that's appropriate to the risk that they bring to the bank. So hence we're seeing this sort of tiered approach where we start at the top, and I need this single database with everybody in there.
Yeah, and that's very consistent with what I'm seeing as well. So when I'm out talking with companies, it's not a rule, but it's sort of an emerging rule of thumb. If you have, say, 20,000 vendors in your vendor population, it's sort of rule of thumb, about 10% of them end up in a managed program. So you may end up with 2,000 in a managed program. And these are tiered, And in the tiering, there's basically, I think people started out kind of with high, moderate, and low, or critical, moderate, et cetera, 3 tiers. The 4th tier that's been emerging is the ones that could bring down the bank if anything goes wrong. So according to Judy McCormick at the OCC, they would expect that this number of relationships you have does not exceed 15. So if you have more than that in your kind of enterprise critical layer, it's probably because your criteria is a little bit too broad. And so I would agree that there's a lot more rigor going into figuring out who they are. Spend is not an indicator of risk. It's just an indicator of, it may be an indicator of importance because you're spending multi-millions of dollars, but it's not a risk indicator. And likewise, a very, very small spend is also not a risk indicator. It really is looking at this much more systematically. Mm-hmm. So if we move on to the next slide, one of the things that I've been working with Crowe Horwath is looking at what does a compliance and completeness program look like? And this is just a nice model that you could measure your own program against. So on the top half, basically, there's the whole concept of identify, assess, manage, and control. And that is the fundamental program that anybody who's managing any form of risk, third party or not, would put in place. So this, if you have a mature enterprise risk management framework or operational risk management framework, these may not be the exact labels, but you're going to find that that's really what is expected, is you can identify which relationships are important to the organization, have a structured assessment program, and I can think even as little as a year ago, people thinking that they couldn't assess on the same basis across multiple types of relationships. But in fact, I think having a more structured approach and looking at the risk categories makes a big difference. And in fact, assessments are quite consistent across your third parties, particularly the vendor side. And what I'm seeing with some organizations that are on the front end of the non-vendor third parties, that they're using the same criteria as the initial filter to determine whether or not certain risk criteria are present, and then they can treat those ones the same for those assessments, and then looking what else needs to be focused on. So for example, a relationship with a broker-dealer, you can still look at many of the same risk criteria, but you may want to put a couple of other assessments in place to look at some of the business impact. Manage is one area that I would have to say is probably still a growth area for people that I'm in contact with. Yeah. Mm-hmm. So the growth area means that it's probably not as mature. So all these principles across the top need to be in place. And then you've got the management principles. So the top half is really the program, and the bottom half is really the governance that you're putting on this. So having the right standards in place, making sure your procedures are documented. And realistically, if you're in a large organization, it's actually not acceptable to run this on SharePoint or Excel any longer. They're looking for some technology that allows you to have better controls. So it's all wrapped around your periodic evaluation, et cetera, coming to this concept of a book of record. So one of the things I'd like to ask you, Mark, is, we are seeing the number of MRAs are declining, but when you start to think about this trust but test hurdle that people have to get through, how are your clients dealing with this evidence-based world with so much data, so much information that they have to put in their book of record? So can you give us some tips on that?
Sure, it's a fair question. I would say generally, and this is just a reality of day-to-day life and third-party oversight, people are doing the governance and those management principles. Those are coming together as they're building the capability internally to manage it. So it's not as though one comes after the other in sort of a linear fashion. Many times they've just got to do it sort of all at once. But I'd say the driver that we see is that you've got to push the work out. There's too much work. So when you think about, if you were to just look at it as on an order of magnitude basis, how many pieces of data do we need to track on how many relationships under how many third parties, you quickly realize with a reasonable staff in my third-party management function, I just can't manage all that data because most of it is very volatile. So most of our clients seek a framework where responsibility for that data can push out to either the line of business relationship owner, because that's the woman or man that really understands what's going on with the third party, and to the third party itself. So in our world, we track a lot of metrics. All that data flows through our system. So we know that for our average client, 78% of that work is pushed out directly to the third party, which is a huge part of just being able to get the job done.
I hear you loud and clear. So we have a question that's come in about the third parties themselves. So, how do they manage all of it? They don't have the resources, et cetera. So one of the things, obviously, is to have a structured approach so you've got an evidence-based system. But another as well is really looking at where does the work belong and not trying to take it all into a center-led group. I also think that automating and making, basically, if you can automate things, your workflow, your data storage, et cetera, so you can get to a better place, which is really managing risk as opposed to managing the activities to figure out what the risk is to manage, you're in a much better place. And that's a lot to do with program maturity. So I have another question about how organizations are referring to their third parties, whether they're suppliers, vendors, third parties, et cetera. And so what's happening now is there is a general trend moving away from vendor management to third-party risk management. And that really acknowledges the broader scope of outsourcers and vendors and non-vendor third parties, such as government-sponsored entities, financial market utilities, joint ventures, all those types of things. So this broad term basically has really come to the forefront in the last year. So I hope that answers the questions.
And on that front, Linda, we see a lot of affinity relationships, very common in certain types of financial services firms that we're not paying them money, but they do qualify as a material third party and need to be managed. And the other entity that's quite common is like a balance sheet affiliate, like a corporate services organization that would provide services to the bank, like facilities, payroll, accounts payable, and so on, that those, in fact, present risk to the bank and need to be managed as well.
Yeah, so I was working with the RMA. We've gone out and looked at the different types of non-vendor third-party relationships. Vendors you pay through accounts payable, so you can find them a little bit more easily. The non-vendors are generally not paid through accounts payable. And so we've come up with, I think, with 19 categories and 55 subcategories. There's a lot out there. So anyhow, so that's probably a subject for another webinar. So I think I'll move on from here. So the next question that we get is really, how do you know that you've identified all your critical services and relationships? So I thought what I would talk about here is what does the FRB focus on versus the OCC? So the FRB, the Federal Reserve Board in particular, one of the largest regulators, is really focused on what they describe as outsourcing activities. And I know from discussions with them, even at the Hiperos Regulatory Forum in March, their focus really is on these vendor/outsourcing relationships. And so this is their definition. The OCC has gone much, much more broadly. And so this is what I picked up from the regulations, but what they're actually asking for is basically any relationship that that the bank has with an entity that is not a customer. So that is a daunting task because these have always been managed in the business. They're not going to be easy to spot. And so, sort of there's where you come to it. So there is a question about what is a book of record, and that's a good question. I mean, it's terms that we use, and I'm trying not to use any lingo. But a book of record basically is a single source that you would look to for all things about your third parties. So that would be basically who owns a relationship, what business does it belong to, what business are they doing with your organization. You can put your contract terms in there. You would store all of your due diligence. You would store performance data, et cetera. And so it becomes the single source of record for all things to do with third-party relationships. And it's important to say that because there are a lot of systems in different organizations, especially the bigger you are, the more likely you are to have multiple systems. And if data is stored elsewhere, that can happen, but you need to be able to point to it so if anybody's looking for information on a third-party relationship, they know where to come. So I think in the interest of time, we'll move on from here. And the polling question, we have a polling question and that Sharon will explain how to respond to, and then we'll come back to our conversation, Mark.
Sure, we have a polling question right now. what percentage of your third parties are you currently managing? And on your screen, you can choose one of the 4 choices available. And we're just going to give everyone a minute to select an answer, and then we'll close out the poll.
Okay, so I want to go back to a comment that you made. You've talked about different types of different industry sectors, Mark, and different types of risk. So you talked about the DOJ, which of course is the Department of Justice. And so what is the financial services sector learning from other industries in terms of managing third-party risks? And maybe you could talk about anti-bribery, anti-corruption, and the work of the Department of Justice.
Sure, and it's a great question. I would say if the question might be, what can banks take away from how other companies are doing this outside of the banking industry? And I'd say there's a couple of marked differences. So most organizations that are managing third parties for bribery and corruption, which by the way is very similar to AML, do it via a closed loop. So they will tie the system into accounts payable so that they get this so that no third party can evade detection. Because, and our customer typically in bribery and corruption would be a chief compliance officer, a general counsel, not a systems person, somebody with a very different perspective than somebody in third-party oversight for a bank, and they're typically lawyers. So they come at it from the point of view of, how do I get a closed-loop system in place where I know I've at least vetted all my third parties, because if there's somebody in there with nefarious intent, they're not going to show themselves too easily. The other one that we see, I mean, this is very common also, like step 1 outside of financial services for a bribery and corruption type use case will be screening. So third party comes into the system, they're automatically screened. We conduct a due diligence questionnaire, which is very similar to a risk assessment questionnaire in banking. And as it collects names, those names are screened. We're looking for political exposure. We're looking for a lot of things. In any case, that tends to be the I'd say the 2 biggest demarcation points from what we see in banking is just that change in posture. Many of the other things we see are still very relevant. So we'll see things like the risk posture varies greatly from institution to institution, which is very common in banks. Some banks are very conservative with the way they assess materiality and apply a rating of high versus medium. Others not the same kind of risk posture, and we see that across the board as well.
Okay, and I think that probably actually, when you look at the results of our poll, what we're seeing here is very consistent with our earlier conversation, that there's a long road ahead for to mature these programs, and so it's just interesting information. It'll help our participants compare their own organization to others. So when you start to think about moving forward, I do think that their comments on anti-bribery, anti-corruption, I actually am seeing these programs in banks now, because they too have to be concerned about the same thing. And
if you read the press, you'll see that the banks have been targeted a lot lately for anti-bribery. It's been a ripe area for the Department of Justice, less so for the Serious Fraud Office, but that's extending into banking now. So a lot of those violations you read about recently are under those FCPA statutes.
Okay. Thanks, Mark. So I'd like to shift gears and talk about how do you translate the guidance into an operating model. So whether you have 10 steps or 15 steps or 3 steps or whatever you want to call it, this lifecycle management approach is very, very consistent with what I'm seeing right across the sector. So the reason why business strategy is sitting outside of the model is because business strategy really does occur outside of the model. Sometimes it has to go to your board of directors because it's a very material change in the way you're doing business. But basically, that's where it all starts, as out in the business. So what I see most often happening is there's a fairly short, quick and dirty inherent risk assessment to determine whether or not the relationship should be part of an overall, an overarching program. So it allows you to come in, ask some very clear questions. And one of the things I would suggest to people is go back and have a look at the wording in your questionnaires when you're dealing with users. This is a team sport. In a larger bank, you're probably involving thousands of people, and in a smaller, it's definitely hundreds. So, when you look at asking questions about inherent risk, for example, you want to keep the questions fairly simple. You want to simplify risk library language so it's easily understandable by any user. And so then you move on, basically, and you've been able to identify your risk present. And I've not depicted the sourcing process where it's a vendor relationship in this model, but that's obviously occurring as an embedded step. So nobody does deep due diligence on anybody but the finalists because it's just too much work. So what I'm seeing there basically is the due diligence actually, it's kind of interesting because these programs, part or all of them are in place. But the amount of structured due diligence is sitting in behind to support your risk assessment seems to be a bit uneven. And it's probably a reflection of their maturity of various risk areas in your organization or even in your own third-party risk area. But the more consistent you can make your due diligence against your risk categories, the easier it is for you to actually start to automate this and come up with very consistent outcomes. So then you're moving on to risk controls and contracting. Risk controls are something that, if you're new to this, I would suggest you work with operational risk management and your many risk subject matter experts internally and with your legal department to understand basically if risk is present, how do I bring a risk control in place into a contract or into a relationship? And the concept I'd also like to introduce here is this whole notion of risk adjusted. So you don't want to have a one-size-fits-all on your controls because you may be imposing more or less control than you want. One example, business continuity management. For one of your large relationships, you should probably be testing the due diligence, or sorry, the business continuity program. And if it's a smaller relationship with less risk, you might be satisfied with assuring yourself that they actually have a business continuity program and that they test it. So basically, there is a question about where do you go for standard due diligence questionnaire topics. I would have to say that this is probably sharing across the sector. Mark, I think that you've got some standard due diligence in one of your service offerings, don't you?
Yes, we do. And what we observe is that most banks follow the same process, and what you've depicted here, Linda, is more or less it. So the details within individual programs vary. So the kind of questions I would ask of a line of business person onboarding a third party to determine materiality, I might have 7 questions, you might have 5, and that's okay. Again, that's each bank putting their own fingerprints on how they manage third-party oversight. But I think the process in general is largely the same. So when we walk into a bank, we go from a starting point where what you see up on the board is what we have pre-configured in the solution.
Right. Okay. So there is some pre-configured due diligence as a starting place in your system. Anyhow, so moving through this, basically, you want to end up with residual risk. A lot of companies aren't quite there yet because they're still working on the risk controls and assessing the residual risk. So that may be an area where your organization is maturing. And then risk approval is an important step. And if you have a system, you can workflow this. And since I'm a chief procurement officer, a CPO emeritus, I'd also, when I have implemented Hiperos, included a deal summary. So you can workflow a lot of things in the system, even if they're not specifically assigned to risk. So getting in front of a senior executive with a deal summary and a risk profile allows them to make more informed decisions around the risk. And then the management and monitoring I have talked about a little bit, but basically this is an area where most organizations are still working on it. So in order to make sure you have consistency and to help your business units and also protect them in the event of an audit or an examination, if you can be explicit about what their responsibilities are for management and monitoring, and there are different tools out there you can bring to help to automate some of the oversight, then that would make it a lot easier for them to do their job. With some of them, there is a reassessment. So I just want to point out that doing a financial viability reassessment on all of your managed relationships is in your best interest. The regulators are hugely focused on financial viability, and it makes sense just to, you can automate that and you can do it every year, and then that's one of those things that just doesn't get the retention, and it gives you more information. And then this whole renewal or terminate. So during this, basically, there's a lot of players involved, and having a system in place can help keep track of who owns a relationship, who's the accountable executive. You can workflow things into your risk areas to let them know what's coming. You can keep track of outstanding items, etc. So this is very much a standard approach, and what you label your different steps varies according to your organization, and you may want to break it down into more sub-steps just to make it easier for others to understand. But this is pretty consistent. So best practices and frequency and monitoring is another question. At the end of the day, I'm just going to go back to basically you want to risk adjust it, so you want to spend more time on your riskier or more critical, higher criticality relationships. And so some of the things I recommend basically are to prescribe activities that you want to see around perhaps service level agreement monitoring and retesting risk, and other things you might want to just give guidance on, because as soon as you make a policy, it's auditable and examinable, and you don't want to get too far into the business. So I'm going to move on from here in the interest of time, and I'm going to just move on to the next slide, which talks about different types of risk categories and due diligence programs. So the reason why I've highlighted some of these and not others is basically, you know, I talk to a lot of people and I talk to the regulators on a regular basis, and these ones that are highlighted are the ones that are of great interest. I talked about financial viability. Model risk is something that's on the regulators' minds. And model risk is basically when there is a model that has been designed that allows you to determine a predetermined model that creates an outcome. So most often this is embedded in a technology. So think about a credit decisioning, a black box, that's a model. Sometimes it's in a consulting arrangement where people are developing models, say for credit portfolio management or for looking at different types of risk tolerance. The other ones are pretty self-explanatory, but I would draw your attention to the FFIEC Outsourcing Examination Handbook, and it's an old regs 2004, but they did put out a new Appendix J just in the last couple of months, and it's very explicit on business continuity management expectations. So there is a question about rolling out critical clauses for vendor contracts, and they're trying to build out the non-vendor processes and determine if critical clauses apply in the non-vendor space. And so the OCC, the question is whether the OCC has any insight on this, and I would have to say that the OCC has not specifically commented on non-vendor third parties except that they expect them in, and they do look to the sector and to their own experience to determine what's happening in terms of the evolution of these programs inside organizations. I'm not aware of any specific insight that's come to anyone that I'm in touch with, and certainly not from them directly. So back to the risk categories, when we have a look at this, basically, one of the questions would be that someone actually asked as a question posed here is, how do you get the third parties to even respond to due diligence questionnaires? Do we have any tips or best practices? Mark, do you want to comment on that?
Sure. That's probably the hardest thing around third-party oversight. Companies quickly realize they go from managing a small number of third parties to a larger number. Thus, the work has to be pushed out to the third parties. So the gating factor becomes getting the third parties to provide this information that's requested of them and getting them to do it without human intervention. And probably the biggest difficulty around that is knowing who to reach out to at your third party. So a rhetorical question I'll often ask is, across all of your third parties, what percent do you have good contact information? A name, a phone number, an email address of somebody on the other side. And it's usually less than what is actually needed. So we have some ways of helping our clients, some technologies that we use to track down who's in charge of what and keep that updated. Well, and in our world, we know the turnover is about 22%. So if Linda's responsible for relationship X, that might last for a little under 5 years before you move on to some other responsibility in the bank or change banks or whatever. So that's the hardest part, is getting the right questionnaire to the right third party. Once we've done that, we've gotten actually very good at adoption. And so our average client is well above 90. I think we're at about 94% right now. So when I send something out, 94% of the time, it just comes back done. But I think the next level of productivity will come from a many-to-many model where a third party will fill something out once and have it shared with all the banks with whom they do business, and that'll help on that front considerably. And we're rapidly moving in that direction. We have so many banking clients, it's a natural extension of what we do to say, let's have the third party fill it out once and share the results, as opposed to the other way around where they have to fill out 50 different questionnaires that are largely the same from 50 different banks.
So thanks, Mark. I'm going to ask Sharon, can you put up the polling question and pose the question? Then, Mark, I'm going to come back to that because I think that's
Sure.
a really, really good point. So, Sharon?
On your screen, you should see now which department owns the third-party risk management policy, framework, and standards. So we have operations, enterprise risk management, procurement, finance, IT, and legal or compliance. If you would please quickly select one, as we are kind of running out of time. We can close out that poll and we can keep going. Let's give everyone a minute.
So, yeah. Okay, so basically, I'm going to actually move on and respond to another question. So someone was asking, what is a non-vendor third party? So they're basically third parties is a very, very broad term for doing business with anyone that's not a customer. And there are really two broad types. One is a vendor, and a vendor is it's a company that you usually can recognize because you're paying them through accounts payable. And so the other is a non-vendor, which is a relationship that usually occurs in the business. So some examples of that would be a broker-dealer relationship, a joint venture, an affiliate relationship. So these are all ones that there is a relationship in place, there is a long-standing agreement between, a formal or informal agreement between your bank and this organization or entity. And but they're not a vendor. You're not paying them through your accounts payable, so they're a lot harder to spot. So I'm going to go to the poll here, Sharon, and I'm going to say that this is actually kind of what I expected. If you asked this question a year ago, I think you would find it spread much more broadly across these different organizations with a heavy predisposition to procurement. What's happening now is that operational risk management or enterprise risk management are encompassing third-party risk management as a part of their overall program. And so I would expect this trend to continue and that this to increase. So let's move on to lifecycle management. So one of the questions that people ask are, how do you harmonize across different regulations, and how do you have global programs to address different regulations? And so one of the things I'd like to say is having worked with different systems, I think if you can come up with a universal program and be informed by the regulations in your major areas of doing business, you can put that in place for most of your organization. If you have a system, you can differentiate between your geographies of businesses or jurisdictions. And if there's special due diligence that needs to be put in place, that's where you can add it because you can launch it from your system. So I'd also think that harmonization is really not such a big problem because each of the regulations is very, very similar, and despite the jurisdiction, it's just not identical. In the U.S., I would have to say that the OCC probably has the clearest guidelines, but please do look to the FFIEC guidelines. They're very, very clear as well, and that's a group of regulatory bodies working together. And so we're seeing a lot coming out of Asia and from MAS, and also the FCA in the UK. At the end of the day, they're all trying to accomplish the same thing. They have a slightly different emphasis on different parts of the regs, but they're very, very similar. And so lifecycle management really is the entire life cycle of your relationship from inception, really from strategy all the way through determination. And there is an expectation that you have very, very clear and well-documented processes, and that you can point to them, that you have a quality assurance program against them, that individuals have the right and the authority and do challenge, and those things must be recorded because there's an expectation that, of course, there are things that you need to challenge, and that you have independent reviews of the program to test for compliance and effectiveness. So moving on from there, Sharon, I think that basically one area that is that we should talk about is the principles of good governance. And Mark, this is probably an area where you're seeing a lot of growth among your customers, because you have to build the basics before you can really get to the outcomes. But in the end, basically, the regulators are going to look at your program just to make sure that it makes sense, but where they're going to spend most of their time is looking at your governance outcomes. So KPIs are key performance indicators, which are the health of your program. So are things working as expected? Do you have unexpected incidents? Are you able to have some predictability? Are you finding that there's a lot of escalations or a lot of exceptions? And those are indicators you might want to make some adjustments. Key risk indicators are actually the health of your portfolio of third-party relationships. And when you're looking at your KRIs, I have to be honest, I think this is really new territory for most. So try to come up with KRIs that make sense. So for example, what percentage of your total portfolio would be acceptable to have high risk in the area of information security? And so, and do the math. Look at the number of relationships in your portfolio, and when you start to set your parameters for, sort of green, yellow, red, do the math and figure out if that makes any sense. And these are a work in progress. They'll change and grow over time. Status reports just allow you to see where things are getting stuck, what's happening in the system, what your volumes are. And then basically the risk reports, they're all historical, but you're looking to see what's actually happened. And as we know, this information is now must be shared with your board or a committee of the board, and it usually is shared with various layers of operational risk management and enterprise risk management. But what I think is a real opportunity is giving this information to the businesses as well, because this would be new for them, and they, in all sincerity, they may not have been aware of risks that they have in their business that they now can see. And the portfolio reports are looking at things like what's happening right across the piece for information security, what's happening with all the different relationships with this service provider, what's happening in this business. And that allows you to take action based on the insight that you have. And hopefully someday will come when we can understand what the triggers are so that we can take action before they happen. So Mark, I'm just going to ask you to briefly comment on what you're seeing in terms of the evolution of KPIs, KRIs, risk tolerance, et cetera.
I'd say it varies. So KRIs being the youngest of them, but I think forward-thinking banks are starting to look at how do I assess how we're doing at third-party oversight. Are we actually reducing the risk of our portfolio? Are we staying the same? Because at the end of the day, I have to justify a budget, and very often at the end of the year, I'm going to be going to my leadership team asking for more headcount. I want to be able to demonstrate the results that we're driving, that if we are in fact reducing the risk to which the bank is exposed, we're creating a more resilient organization that's worth more in the public markets. And so that one, I think, is an important one to help the third-party oversight organization to sell itself internally. On KPIs, I think the OCC has made it clear you have to manage performance. And we've all always known this. Performance management is just a risk discipline. I keep my most strategic third parties close because they expose me to risk, and I want to make sure they're performing up to snuff. And so what we see there is clients taking a stratified approach. With my most strategic third parties, I go very deep. With third parties that are material but not necessarily strategic or critical, I might do sort of a white sat survey so that we're keeping our finger on the pulse, but the level of due diligence we do in the performance management area scales to the risk. And then the last one is on those risk reports. We see this quite a bit now is I have to take this to the board where the person who's responsible for third-party management in the firm goes up to the board once a quarter with a nice dashboard that shows how we're doing, where the risk is, and then review of those critical relationships.
Right, and the action that's being taken. That absolutely is a trend. One of the things that I think I don't see it very often, but I think it's probably going to happen is, key performance indicators for individuals working in companies today might have a reference to sound risk management practices. I have seen this in one or two banks where, in fact, their ability to manage third-party risk within the tolerances set by the bank is part of executives' annual performance goals. And I don't doubt that this is where it's going, because in the end, I mean, that's what banks do, right? They measure what's important, and as this gets to be more and more important, I think you're going to find that to be a common practice, because this doesn't all fall on third-party risk or the vendors or the risk experts. It really is. It is a new way of doing business, and it's really important that people are paying attention to it. So, just a thought there. So moving on. Oh, there is a question basically. How can you plan ahead for is there a way to plan for headcounts? One of the things I'm seeing, I don't know if it's right or not, but there's somewhere between 100 and 200 relationships per person in the third-party risk management area seems to be fairly common today. And I know that's a broad spectrum, because it's 100 is only half of 200, but I don't think there are any hard and fast rules. And one of the other questions was also, there's cost for a lot of the documentation that these companies are providing, that you have to get in queue sometimes. You can't get your due diligence completed. Sometimes you don't have rights to audit, or you want an audit. So these can be very, very expensive. So let's say that you require a SOC 2 or an SSAE 16 where they didn't exist. You could be looking at $60,000 to $100,000. So don't ask for them lightly. And where you don't have a right to audit, you just determine whether or not you really need it right now, and that's something you could negotiate in your next contract. So moving on to governance models, I think we've been sort of angling towards this, but this is a fairly common structure for a governance framework. The board of directors, enterprise risk management, and the third-party risk management governance committee are kind of sitting at the top of the house in terms of managing third-party risk. What is a very rapidly emerging trend, I'm starting to see this more and more, is the third-party risk management committee is not reporting in, they report dotted line into or dual reporting relationship to enterprise risk management, and they report directly to a committee of the board. So the boards are very, very burdened in terms of audit and risk. And so in some cases, it's a committee reporting into audit. Sometimes it's a committee reporting into the risk committee in the board, and sometimes it's a separate committee at the board level. So what that tells me is that people are really standing up and paying attention to this. It is very, very important that they are getting it, that there's great value in having the information and better managing their organizations. And so if you don't have a third-party risk management governance committee, I would recommend you put one in place immediately. And you should also have some very senior people on there from the business, maybe from compliance or audit. Audit usually sits as an ex officio, whoever heads up third-party risk management. But you want basically people who have the authority to make decisions, because this is a point of escalation where there are issues or where there's a request for an exception around risk approval. So I did want to touch on that. And then basically this whole idea of policies and standards. Sometimes you are dealing with multiple policies. Standards is something that a lot of companies have moved towards, so they take all the details out of their policies and they specify them in standards, and then even more detail in the procedures. And then this whole concept of book of record. I can't stress that enough, that you need to have workflow, repeatable processes. You have to have documentary evidence of the decisions that you made and the evidence that you've collected. And it's a good place for you to analyze to figure out what's actually happening. This all takes time, but this is a pretty standard model too. So I'm going to just ask you to comment. I think, Sharon, you've got a polling question that you wanted to pose, and then we'll talk about what's happening in governance.
I do. Let's look at that. Let's look at that quick. What tools do you use to manage your third-party program? Excel, SharePoint, and Access. Number 2, a GRC platform such as Archer or MetricStream. Number 3, a spend management solution like Ariba. Number 4, a homegrown application. Or number 5, something completely different. So I will launch that right now.
Okay. Well, thanks, Sharon. So basically, if you go back to governance, one of the things that I would observe is that there's so much effort being put in place right now in putting the programs in place and getting all of your due diligence documentation organized so they be consistent. But the real point of this is actually proactively managing third-party risk. And so trying to get to a point where you actually have good governance and you're not completely chewed up in the activities is really, really important for an organization. So, Mark, what are you seeing in terms of changes in this area over the last year? What do you think is happening with the overall outcomes in the governance?
Well, one of the things that strikes me is something we discussed earlier, which is lessons from other industries. It's quite common outside of banking for somebody responsible for a compliance program, like a chief compliance officer at a large industrial manufacturer. That CCO will report to a general counsel, who in turn reports to the CEO, who in turn reports to the board. But that CCO also has a direct reporting relationship to the audit committee of the board. So they have the opportunity to go directly to the board and have a discussion if there is risk that's not being addressed, which is rather important.
And that's very consistent with what's happening in the financial services sector. So rather than having the chief compliance officer going directly, there is an opportunity for the governance committee in most organizations to bypass and go directly, because this is such a serious topic. So this is interesting. The poll results are interesting to me. I guess I shouldn't be surprised, but I'm surprised how many people are still using Excel.
I am surprised, yeah.
So yeah, that's kind of interesting. So anyhow, that's a pretty tough way to manage, and it's going to be hard to get to outcomes because you're going to spend an awful lot of time on tactics. Okay, so moving on to our next topic, I just really want to have a conversation with you, Mark, about what are you seeing in terms of top 10. This is kind of my top 10 of what I think are critical success factors. So maybe we could start with you, and what are you seeing?
Well, so I'd say the first thing that's most important, and when we put aside technology and so on, I'd say the difference between organizations that are very successful and organizations that aren't is the degree to which they have leadership team support. And this is common across all of our clients. I don't think this is a function of banking, but I would say that having leadership team support is important, so that a third party, when they push back, they'll get pushed right back between the guardrails where they need to be in order to help the bank to manage as they're supposed to. And in order to have leadership...
So Mark, can I just ask you a question on that? One of the things that we're hearing more and more about is the concept of a risk culture. So are you suggesting that there are still organizations out there that don't have a strong risk culture around third-party risk management?
Yes, I would characterize it less as a risk culture and more about the ability of the third-party oversight organization to sell themselves internally. I mean, think about it. If you're a CEO or a CFO and somebody comes to you, you're going to look at them and make a judgment about how well they're running whatever it is they're responsible for, if they seem knowledgeable, if they seem trustworthy, if they seem literate, professional, do they deliver, et cetera, all the same things anybody would do. So I'd say, that axiom about selling yourself is, I think, especially important when we're founding a new discipline within the bank that needs to be broadly adopted. And I think largely leadership teams today are open to it. They realize this is not going away. This is not a flash in the pan where, 18 months from now it'll die down and we don't have to worry about it anymore. So I think it's becoming easier, but we in the third-party oversight organization have to step up. We have to develop metrics that we manage ourselves by. We have to understand our portfolios. We have to be credible in the commission of what we do. Otherwise, everything else becomes really so much harder.
So I just want to address a challenge, or the question around effective challenge that's come up, because that actually leads into the response to the question. Someone asked, what's an effective challenge in the governance framework? Mm-hmm. So the concept of challenge basically is everyone who is in a risk area, particularly in the second line of defense. So you've got the first line of defense is a business. The second line of defense is third-party risk management, enterprise risk management, and any risk expert that's supporting the business. And the third line of defense is audit. So if you're sitting in the second line of defense, where it comes to third-party risk management and any other risk topic, there really needs to be evidence that you have the authority and that you can effectively challenge decisions that are outside of the risk tolerance or really not good for the organization. So organizations that have done this well have documented a challenge process to make sure it's very clear. So it's a policy or a procedure that describes what happens in the challenge function. But realistically, third-party risk management usually ends up being the kind of the aggregator for challenges because they should be involved in what's happening. So let's say that information security has deemed that this company is unsafe risk. They don't think that you should be doing business with them. And so they can come and work with third-party risk management, and together you can challenge the business to say, with this structure, they're going to have unencrypted information, or they may be having we don't know who the third parties are, and it's a follow the sun, and so they're going to have access to customer information during that period. When it's after hours, we need technical support. Those types of things where you're unable to assess the risk or uncomfortable with the risk are things that are not acceptable in today's environment. So in the past, the business could just say, well, that's okay, I'm going to accept the risk anyways. In today's environment, that's not appropriate. So you would go back to the business and say, gosh, you can't do it this way. Can we restructure this? Can you deal with another service provider? If they want to continue on, basically it becomes an escalated challenge. And it can go right up to the risk committee of the board or wherever your challenge ends. But that's what an effective challenge is. And that kind of leads back to what you were saying basically about tone from the top and the support and the authority and the credibility to do your job well.
And you just have to be aware that those effective challenges sometimes challenge the top of the house. So I may have a CFO who's very supportive of everything we're doing, and then when it comes to managing McKinsey, he says, oh, no, or a consulting firm that he brought into the firm to help him, he may say, oh, no, they're excluded from oversight. Let's just skip over those. That warrants an effective challenge, and we have to have an environment where that can be challenged. But sometimes it's from the GC saying, let's keep our law firms out of this, to wom we outsource legal work.
That's exactly the example I was going to give.
Yeah. And outside of banking, they adopted a whistleblower type paradigm where anybody in the organization that sees something that smells bad has an opportunity to raise their hand and report it and know that it'll be dealt with appropriately by somebody who's one step removed.
Right, and that's the ombudsman. But realistically, I mean, it does take courage to be in a third-party risk management program, because you're sitting in the center. You may be challenging people who are far more senior than you are. You need to know that the company is behind you, and that if you reasonably challenge that it makes sense for you to do so. So really where we want to end up is, what's the end game? The end game basically is, we talked a lot about risk. Mark, you touched a bit on performance, but in the end, what you really want to consider is, how can you develop a portfolio view of your third parties and the things that should be in your portfolio for closer management against these three dimensions of risk, performance, and value. And I think if you can reach there, that you can provide good conversations and information to your executive management team, you're in a very good place. With that, Sharon, I'm going to turn things back to you to wrap up.
Sure. So this concludes our session for today. If there are any questions that we did not address during the webinar, or feel free to reach out to us at www.hiperos.com. And there's always a contact us form you can use on our website. The slides and the recorded webcast will be uploaded onto our website at the beginning of next week and available for replay. And we appreciate your participation, and we look forward to seeing you at our next event. Thank you, and have a great day.